Hello everyone, this is DeLorenzo from United Asset Strategies. I'm joined today by Thomas Healy, the Director of Client Portfolio Analysis. You know, to say that 2020 has been a most unusual year would be an understatement. There's been so many curveballs, stops and starts in metrics like our health, our finance, social justice, and our faith. It's been compounded by a never-ending stream of conflicting news, mostly negative. And we find ourselves here at United Asset Strategies reminding ourselves and each other to stay grounded and well-balanced, just like an investment portfolio. So today I would like to ask Tom, for the benefit of our audience, to answer a few questions regarding the market, what's been going on and where we're going, and what's shaping our actions within your portfolios. So Tom, results for the quarter were actually positive across most asset classes. Did the divergence between growth and value continue?
Sure, good question. Yeah, absolutely. If you look at the way the third quarter played out, the S&P 500 index was up about 8.5% total return for the quarter. But again, S&P value was up 4.8%, so 370 basis points below the average, where the S&P growth index was actually up 11.8%, so 330 basis points above the average. And when you look at the sectors were led by technology and communication services, your traditional growth sectors, and your more value-oriented sectors like financials and energy were again down for the quarter. So it just seems like in this low growth environment, we have that dynamic where growth outperforms value, and that's been the case.
So those statistics that you shared were for the quarter. What does it look like for the year-to-date now?
Right, for year-to-date it's even more divergent. The S&P 500 is up 5.6%, but it's worth noting that that's really a concentrated return, a handful of companies driving that. If you look at the S&P equal weighted index, which looks at the average of all the stocks, it's actually down 4.8%. And then value versus growth is up 20.6% year-to-date, where value is down 11.5%. You're talking about a 32% divergence, about as large as we've ever seen between growth and value. The technology sector up 29% for the year, whereas financials are down 19% and energy is down 50%, 50. So again, that divergence and the concentration we've seen that started in January has continued throughout this year.
So taking a look at the rest of the year, we certainly anticipate continued, if not increased, volatility. So I'd like to ask you a few questions regarding what's driving this, and I'd like to start with monetary policy, both here and abroad.
Sure. The monetary policy response globally has been very robust. Here in the United States, the Federal Reserve balance sheet is now up to 33% of GDP. That was at 19% as of the end of last year, and only 6% in 2007. We've seen similar types of increases in Europe with the ECB, and also in Asia, particularly the Bank of Japan. We think that the monetary response has been the most critical of the two pieces needed to stabilize markets and also stabilize the economy. And we've seen nothing said out of Fed Chairman Powell in recent weeks to suggest that the Fed won't remain accommodative.
So we're going to talk about the election later, but as long as you said that, is there any hint that if we did have a change in president, that there'd be a change in the Federal Reserve leader?
It doesn't look like that at this point. I think traditionally the Federal Reserve has been, not political, and we don't see any indication, we're not hearing any indications that there would be a major shift in monetary policy or in the monetary leadership with the new administration.
Thank you. So to now address the fiscal policy response here in the United States as opposed to monetary, or lack thereof, why don't you give me a few comments on that?
Sure. The good news is once the pandemic hit and the economy was locked down, Congress moved in a bipartisan way fairly aggressively. We had a $2.2 trillion CARES Act, which was the largest fiscal stimulus in U.S. history, representing about 10% of GDP. The bad news is that key provisions expired. And the idea was once they expire, we'll reassess and determine if more stimulus is needed. Now that's clearly the case. More stimulus is needed for the economy, particularly since we're still in this COVID pandemic. Unfortunately, it's become much more partisan in recent weeks. And right now, as it stands, there was a very wide divergence between the Republicans and Democrats It's getting closer, but it's just been a day-to-day news event, as you mentioned earlier. The news flow is one day it feels like it's going to happen, the next day it feels like it's dead. And so, but the bottom line is we believe that for the economy and earnings and to recover, we do need another fiscal stimulus package.
So regarding the recovery in the economy and earnings for corporations, what do you see going forward?
Sure. Taking a step back first, coming into this year, the economy was on solid footing. You look at a lot of the data that we assess, whether it's consumer confidence, manufacturing, housing, labor, was very strong, some of it at long-term highs. Then when the pandemic hit, the economy was pulled back. It was probably the most unprecedented decline in economic data that we've ever seen. More recently, thanks to the monetary response and then the fiscal stimulus package, we've seen a stabilization and a return to some economic growth. Some of the data has been more V-like U.S. manufacturing, like PMI. Others has been more U-like consumer confidence, and a little more jagged in its recovery. The one area that's been universally strong is housing, with historically low mortgage rates driving the housing market. But again, our view is the economy and also earnings, for that to continue on an upward trajectory, we definitely need another fiscal stimulus package.
So lastly, let's turn it to the election. You know, a lot of our clients have been calling, emailing, and they want to know what we're doing, what we're looking at, the timing that we might invoke in any changes. And I'd love for you to talk about what we've already done, never mind where we'll be going. So let's talk about the election.
Okay, so what we do is we assess the data. Based on the data, we want to determine what we think the outcome will be. But right now, the uncertainty level is about as high as I've ever seen as a policy analyst. So what we're doing is we're looking at different scenarios as a team. We're stress testing those scenarios across our portfolios to determine where are our exposures, where are areas we need to add to, where are areas, certain sectors that we need to start reducing, and then overall risk in the portfolio. So when we look at the data, a couple of things that we're seeing is in the presidential race, we look at the head-to-head polling right now. Former Vice President Biden has about a 9.5% lead. If you look at the aggregate polling, the Real Clear Politics aggregates. And the president's approval rating is at a level right now which is consistent with previous elections that were negative in terms of not successful. In other words, Carter and the first Bush both lost their bids for re-election and had a similar approval rating as does President Trump right now. And then the third thing we look at is the key swing states, the Michigans, Florida, Ohio, Wisconsin. In those races right now, former Vice President Biden has a lead between 2 to 5% across the board in those key swing states. So that's something we're watching very closely. The one thing I can say with somewhat confidence is that the House will remain in Democratic hands. So the Senate becomes critical as well. Right now, the Republicans have a 3-seat majority. For the Democrats to take control of the Senate, they need 3 seats if they have the White House and 4 seats if they don't. There are some key Senate races right now where Republican incumbents are losing to their Democratic opponents. And that's Colorado, Maine, Arizona. There is a critical race in North Carolina that the Democrat was leading. There's been a bit of a scandal, so to speak. Again, this is a very fluid situation. So what we're not doing is taking a bet and then making provocative decisions based on a bet. Because right now, there are definitely trajectory-changing events that can occur. I mean, the last week alone, we had a very, I guess you call, chaotic debate, followed by a president who was announced that he had COVID-19, and again, in North Carolina over the weekend, breaking news that could change that key Senate race as well. So there's a lot that can happen in the next few weeks to change things. So we're not taking big bets. But what we're doing is our analysis, our assessment. We're making important decisions on the way there, but also we have to remind ourselves that this election may not be determined on November 3rd. With a lot of the mail-in ballots and some of the key states don't begin counting those ballots until election day, this could be another Bush Gore type of scenario that takes a few more weeks. So the team is also incorporating that potential in our scenario analysis. And again, the decisions we make are long-term disciplined decisions, but with short-term tactical changes needed based on our assessment of the data.
So the well-diversified portfolio with active management is more critical than ever going into the end of the year with this increased volatility. And some of the things that we've been talking to clients about has to do with their unique income tax situation, as well as their estate tax situation. And as the presidential likelihoods unfold, you'll hear us talking to you about dollar cost averaging into the market, dollar cost averaging out of the market, almost a reverse. We have a very diverse client base, both in their political outlooks as well as their income tax and asset levels. So some of our consultations regarding from a financial planning perspective have been about accelerating income or accelerating deductions, and on other clients it's almost pushing it into 2021. There is no blanket solution for any of our clients. We need to talk with you. We need to understand your exposure to different areas of the marketplace as it relates to either presidential win. We're seeing that certain individuals want to inflict their bias. You need to hear us out. We're not judging someone's tax plan. We just understand the tax plan and we can overlay it onto your situation. So please know we don't have a bias. We just know the facts. We know what we think is going to happen based on history, and we want to customize our strategies, both investments and tax, for you. So I want to thank you, Tom. It was a good give and take, and I realize that it is the last time we're actually going to be recording this style until next year. So I can't think of a better time to wish you all a very happy Thanksgiving and to thank you all very much for your business, and we hope that you stay safe and sane for the rest of the year. Thank you.